And really, as you're talking about value, you're talking about, a merger or an exit. You really need to know what the value of your business is. You need to start thinking about value in advance and what are the drivers of value. So that's kind of what we want to talk about today. And I'm going to be taking the first part of it, which is really preparing for a merger or an exit, the things you need to think about with regard to your business and the content of your business planning forward. It is a process that you have to go through and prepare for. It can be multi-year sometimes. And with regard to M&A considerations, Terry's going to walk us through some of the things there. Same thing, there's a real process that's involved. You have to be prepared for that. So we're going to cover both of those things. I'm going to start and I'm going to do the handoff to Terry. And I've already introduced myself, but really in preparing for a merger or an exit, obviously, a successful exit or a merger can be very rewarding for a business, for, owner operators, entrepreneurs like yourself, having worked all of those years, built up a really great suite of intellectual property. If you're a tech company or, having expanded your business to the point where there's great value for you and your family, whether or not you're looking at a succession plan, looking at a merger, you are looking at some point of taking that money off the table. And taking all of that wealth that you've created, hopefully, and being able to enjoy life and sit on the beach a little bit more, or do whatever you like to do with your, with your free time or your leisure time. And therefore, planning is really critical to maximize overall value. If you've got a really solid platform in place, by the time you go to sell, you'll sell more quickly because you'll have a greater appetite in the market. You're likely to get higher valuations, some more money for you. And if you've got other shareholders in the business, you can certainly deliver on your promise to maximize the post-tax value. We'll talk a little bit about tax and the impact of tax in this session as well, but maximizing the value for those shareholders. For those of you that have other shareholders in your business, you've had other investors come in at various stages, whether it's family and friends, seed round, Series A through C, PE, whatever it is, certainly that's part of the mandate once you get there is to maximize the value for them. And also, in the process, when you get to that stage that Terry's going to be walking us through, you really need to be able to demonstrate that you've got reliable information, that it can stand up to scrutiny. You've got systems in place that allow you to report and forecast accurately. So you've really got a good fix on where your business has been and where it's going. And that shows through in the information in a data room that you're going to need to create if you're going to be exiting or even merging the business with another company. And it really does instill confidence when you've got that in place with potential acquirers, as well as advisors that are going to be sitting on your side of the table, but also on the other side of the table, to maximize price, to maximize multiples in the business, because the company's specific risk is minimized when you've really got your information and your platform very solid and together. So in terms of preparing for a transaction, the condition of the business at the point of sale will be determined really by what your future profits and cash flows are going to look like for the successors of the business. What confidence do they have that the business that they're acquiring is going to continue to generate the kind of cash returns that they've been seeing historically, or that you're showing in present day. And you have to be in a position always to take advantage of exit opportunities when they arise. I think I heard somebody this morning say that they're getting inquiries from PE firms all the time. Well, wouldn't it be nice if one day that you woke up and you decided, hey, maybe it is time to take money off the table. Something has changed in my life. I think it would be a great idea to be able to sell my greatest asset that I worked so hard on, to be able to maximize that value and take advantage of those opportunities when they do arise. And being prepared and in a position to really start that process fairly quickly, puts you in a position of strength. Some of the things to consider when you're looking at exiting or a merger is, what kind of an ownership structure you've got in place. We'll talk a little bit about real property, real estate, intellectual property, the importance of your contracts. That's really important. I've been through a number of these transactions, and I can't tell you the number of times that we're scrambling for contracts at the last minute because something has been put in place, something wasn't signed, And it does hold up a deal. I've seen it hold up a deal. One small contract that somebody needed, and the lawyers insisted that it be in place, and we were scrambling around trying to put it in place, or find it, or get it signed or renewed. So that's a very important piece. Won't spend too much time on pension plans, but did want to review them a little bit. Just talk about them very briefly. Financial records, also a very critical area. As you're selling your business, you've got to have very clean, clear financial records that tie into your, whether you're doing notice to reader statements, review engagement statements, audited statements. Your internal records have to tie into those statements, and you've got to have clean records around who owes you money, who you owe money to, clean payroll records, all of those things. And then we'll just touch briefly. I think Terry's going to talk about this in a little more detail, so I'll just touch on it very briefly. Is really, the process of due diligence and the importance of getting the right advisors in your business as you're going through this, whether you're doing a merger and you're doing your due diligence, or you're dealing with advisors on the other side. You've got your own advisors, and going through that due diligence process yourself if you're exiting your business. In terms of an ownership structure, I mean, obviously a single shareholder is the easiest thing to deal with, but often, many of you being in the tech space are going to have multiple rounds of financing. So, in the case of multiple owners, making sure that you've got a shareholders agreement in place, a unanimous shareholders agreement that's tight, that's, been well defined, that spells out the terms of exit, that there's unanimous agreement on what those terms are going to be, so that at the point when you go to sell the business or merge with another business, you're not scrambling around trying to negotiate a deal with your own shareholder group to be able to proceed forward. You need to know exactly what the terms are going to be. And then the procedures that are going to be followed for exit, those need to be spelled out in the shareholders agreement as well, as to how it's going to happen, what has to happen, what documents need to be signed, all very important to have in place, so you've got a smooth road to be able to work through and follow as you work through this process. An agreement among your shareholders on the valuation methodology in advance, in terms of how you're all going to agree on what the value of the business is. Ultimately, and Terry will go into this in more detail, ultimately the value is going to be what somebody's willing to pay. But in terms of getting your own independent valuation done, so you have a sense as to the kind of value you should be looking for, or at least a range, important that you all agree as shareholders to that methodology up front, again, so that there's a very clear path as to how that's going to happen when the opportunity or the decision arises to exit or merge with another business. And then what are the rights? The shareholders need to know what their rights are on sale or death or critical illness of another shareholder. What happens with regard to acquiring, those shares internally, and what's the process for doing that. So these things are really important to have in place when you do have multiple shareholders, which is, a case where some or many of you may have. Also, with regard to ownership, not so much, but key employee considerations such as share options on an exit. One of the greatest challenges that everybody's having these days is recruiting and retaining top talent. And part of the retention plan for a lot of businesses is having that upside potential for employees to enjoy when there is an exit of the business or there is a merger, so that part of their compensation can come in the form of the right to participate in that financial upside and gain through things like share options. So that's something else to make sure that you've got a really good fix on, because a buyer is going to want to know is, okay, if we're taking on employees, are there share options that we need to deal with and do a share swap? Do we need to consider, what the consideration is going to be for those? So having that spelled out very clearly is important as well. And then again, seeking professional advice on the proper structure to maximize the value. And this is really about the tax structure of your business. All of you as you're starting out in your business, you don't think about exit because you're just starting out and you think you have a long road ahead. And yes, you do. Lots of things to build, lots to work on, lots of value to create. And we've got, a timeline in mind, but it's never too early to start planning and putting the proper structure in place to allow you to, ultimately achieve your objective with regard to, putting family trusts in place, those kinds of things. get a good, strong tax advisor to look at a structure that makes sense, that isn't terribly complicated, but does allow you to, take advantage of the elements of the Tax Act that will allow you to keep more of the money that you've worked so hard to create. Just want to touch a little bit on the importance of real estate in a transaction. It can be a major consideration for a purchaser if you're operating in a leased versus an owned facility. Being in the tech space, probably a lot of you are in leased premises or working virtually. You have virtual offices. But for some businesses that have real estate, it can constitute, a significant portion of the value of the business. And again, getting back to structuring that properly, a lot of companies will put the real estate in another holding company and then do a lease and sell it separately or sell it together with the business. But getting advice in terms of what's the best way to deal with the real estate portion of it, and probably have to maybe get another type of valuation, an independent property appraisal. But always important to make sure that as you're thinking about selling or merging, what's the current value? Have you had a current valuation done on the property so that it's reflected properly on the balance sheet? Because an acquirer is going to be looking at your financial statements, going to be looking at your balance sheet. A strong balance sheet is very attractive to buyers because they can leverage that to help finance a transaction, to help grow the business post transaction closing. So making sure that the value of the real estate is up to date is really critical as well. And what's the income generating potential of it? A buyer may look at it, or in a merger, your partner may look at it and say, hey, there's some things that we can do with the real estate rather than, just simply operating in it. Or, you may decide to keep the real estate, and then you need to understand what the income generating potential of that real estate is. If you decide to sell the business separate from the real estate, keep the real estate and either lease it to the buyer's business or lease it to another party. So again, the structure of the property holding is really critical, and finding the most tax efficient way to do it against what your ultimate plans are really important. And then if you are leasing the facility, making sure that you've got a good fix on what your current lease commitments are, and whether or not you want to renew a lease. You've got favorable terms possibly that you want to continue on. If you're thinking about 2-3 years down the road, maybe doing a merger or exiting the business or putting in a succession plan, really getting a sense, because that's, your real estate costs, whether you own or lease, are pretty significant to your business. And you want a good fix on what that lease stream, that commitment stream is going to look like, for a potential buyer. Intellectual property. This is probably more to the heart of what many of you are concerned about. You're in the technology space, so you're looking at products and processes that have been developed over time by yourselves and your team. Products, processes, brands that have been created. How critical are these to the future income of the business and the cash flow streams, and really understanding that and making sure that you've locked things down. You've protected that intellectual property for as long as possible in the markets that you want to operate in, that you want to go into. It is, yes, an arduous and expensive process, but as many of you will know, it's really worth doing, because buyers will want to know, how long do we have this protection for? How long do these patents go? In the various markets, how have you protected your trademarks? What real value do those bring? Because that could be a significant portion of your goodwill value in the business. Because many of you are in the tech space, you may not have a lot of fixed assets. So the value of the business is really around the IP that you've created, over time in building the business and building out your markets and building your brand. And then looking at, opportunities with regard to innovation. Have you taken advantage of, the scientific research and experimental development credits? Any other, tax credits or grant programs that you can stack on top of that? And is the accrual for that kind of benefit reflected accurately in your balance sheet and your income statement? As an offset to some of the costs that you've had, and making sure that you've got, the right advisors on, applying for your shred credits, whether you do it yourself or you use somebody else. Really important to have a good fix on that, and that it is properly reflected in your financial statements. particularly if you're showing interim statements that have not been reviewed at the end of your fiscal year. And if that's part of the conversation with a potential buyer. And then getting the proper IP assignments from key employees is really critical as well. You don't want a buyer or a potential partner in a merger concerned about the fact that the intellectual property is kind of floating in the hands of the employees, who could walk out the door and across the street to a competitor. You really need to be able to lock those assignments down as you're getting into the stage of selling your business. This one I want to spend a little bit of time on contracts. As I mentioned before, making sure that you've got your arrangements with your customers and your suppliers in formal fashion, that they're well documented, so that a buyer coming in is going to know that you've got good strong terms with your suppliers, that there's going to be no supply chain risk attached to the business going forward. That it's clearly spelled out what your arrangements are with your customers with regard to what you're selling to them, what the terms of those sales are going to be, how quickly they're going to pay. So really important to have all those contracts, especially the key ones that are mission critical to your business, kind of locked down. If you use a technology platform, to drive your business, whether it's, even just something as simple as a mobile platform or, an ERP system, is that, very clearly spelled out and well documented. And are these contracts current, including with any legislative changes that have happened, if any of you are operating in highly governed industries or highly regulated industries? Do your contracts reflect any legislative changes around those industries that could be of concern to a buyer? And are there change in control provisions in some of these contracts? Often a large customer in particular, will want to have a say over who runs the business. If they've been enjoying success and having you as a really strong supplier for a number of years, they may be very concerned as to what the plans of a new party coming in, whether it be a partner in a merger or somebody taking over the business and acquiring the business. What are their plans for the business? And so really important that people understand what those change of control provisions are. And if you do require approval from that customer, making sure that you're getting out in front of it early in the process so that it isn't something that holds you up at the end. Because that can be very frustrating for all parties if a customer says, hey, we didn't see this coming. It was a big surprise to us. And now you're asking us to sign over this document and sign an assignment of our contract with you over to a party that we don't even know who they are. And so you don't want that coming up and spoiling the process at the last minute. And that's really, this sort of ties in the relationship with you as the existing owner and the plans of new ownership. That's really going to be important. If they've enjoyed a strong relationship with you and your plan is to stay on with the business for maybe a year or two, if you're exiting fully, to help with the transition, it's important that they understand that. Give them some comfort that in the short term they're going to be part of a transition plan as opposed to something that changes overnight with the stroke of the pen. Now when you're going through this process and you're thinking about these things, the risk of customer or supplier concentration is something that a business should always think about. If 60% of your sales are to one customer, that's going to affect the value of your business. I mean, in some cases it's unavoidable. You're in a space where you're growing a business and all of a sudden you get that first big contract, and for the next fiscal year that's going to represent 75% of your sales. Longer term, as you're thinking about exiting, just be aware that that kind of concentration reflects risk, and risk is going to affect multiples, and that's ultimately going to affect the value of the business. So be mindful of that. In some cases it can't be helped. You've got some large customers, you've got some large suppliers. They do constitute a big part of your business in terms of your revenue stream and your supply chain. Just be aware of that as you're thinking about the multiple, that can actually affect the valuation of your business too. And it's more really a reality check than anything else. And just to be aware of that. Pension plans, won't spend too much time on it. Most of you won't have, hopefully, defined benefit plans, because if you do, you do have to really assess and value the funding position of the plan. It is a major concern for purchasers if they're coming in and They want to know that the plan is fully funded and there isn't some, long-standing deficit that they're going to have to fund post-transaction to bring the plan up to date. I've seen cases where, the plan deficits actually exceed the value of the business because they just haven't been revalued. There haven't been significant enough contributions from the business to the plan to meet the ongoing needs of the plan beneficiaries, and it's actually crippled companies in the end. But hopefully, you're not having to deal with that. But it's important, if you do, to have regular reviews and appraisals of those plans to ensure that they're fully funded if you're thinking about going into a transaction. Financial records, really critical to have these in place. Have them solid. Make sure that everything is properly filed. All of your filings up to date, HST. All of your payroll records. The quality of these records and your ability to develop formal budgets and forecasts from good, strong records, and to be able to have a process that you're comparing historical to actual results, really can affect the confidence of people that are taking a look at your business, whether they want to become a partner or whether or not they want to acquire you. It really does affect company-specific risk as you're going through due diligence and you're not able to meet the information requests. Your data room has got all kinds of gaps in it that the buyer has to keep asking for, and their advisors, and you have to create on the fly. That really does affect confidence and will drag things out. And I've seen transactions that went for months and months in process and then basically kind of just died on the vine because the buyer just became disinterested and said, look, we're not getting the information that we need. We thought, on the surface that you guys had a really tight, operation. But as we're going through it, we've just got so many questions and things just don't seem to tie together. So you've got to really have a good fix on what your, trends in profitability and cash flow have been. Having a forecast in place, really important, making sure that you've got a budget that you're reviewing regularly, at least monthly, against with your actuals, so that you can clearly explain any variances from the norm. If you've got unusual expenses that have occurred, say, historically, and that's how your business is going to be valued, you want to be able to clearly explain those, and especially if you're taking the position that those are one-time expenses, those are one-time events, not to be repeated in the future. So we're normalizing our earnings for that and be able to have that stand up in argument to somebody who's going to be looking at it and say, well, convince me that they're one time and that I'm not going to experience them after I acquire the business. And then also, what's the impact of what we call extraneous costs? So are there owner and family benefits in the business? Are there automobiles that are being run through the business? Do you have people on the payroll that aren't really critical to the business, but it's tax efficient to do so? You want to be aware of those kinds of things too, because they wouldn't be part of normal operations for somebody else running the business. And it all speaks to having that good normalized set of earnings that an acquirer can expect to enjoy as they complete the acquisition of your business and operate it going forward. So really important to have a good, clean set of records, including all your tax filings, your regulatory filings. They really need to be very clean to be able to stand up to purchase or due diligence, and that'll make a much it'll contribute to a much smoother process. I'm not going to go through this checklist. I believe we'll provide the deck to Tech Connects and share it. But this is really just a minimum checklist, and for your specific business, there's going to be other things, but there's just some basic things that you really need to have in the data room that a buyer is going to want to be looking at in terms of descriptions of your assets and your corporate articles and all your tax returns, your financials for at least 3 years, letters from your auditors or your accountants. As I said, all of your filings, your contracts. They're want to basically look at the entirety of the papering of your business to be able to make sure they have a fulsome understanding. And that's all I wanted to talk about. I'm happy to answer questions now or at the end, or if any questions have come up along the way before I turn it over to Terry to talk about M&A considerations.
Jeff, I'm a bit curious about the contract that you mentioned that sort of upset the apple cart with one of the deals that you were working on. Specifics on that, like what contract was that? And
It Yeah, it wasn't even a large contract. It was a small little contract. I was part of a business that provided healthcare services in the community. It was a community health business, and we had contracts across the country with government agencies. And we had one little contract in BC that hadn't been signed because it had been renewed and it hadn't been signed. And chasing down the signature at the last minute, really upset everybody because we were just about to close and we almost had everything in with all the lawyers, and we were just about there at the finish line, and somebody said, "Well, where's this contract?" And it wasn't even that large of a contract, but the fact that we didn't have it, and everybody scrambling around at the last minute. So it was very early on in my career and really taught me a lesson that if you tell me we've got a contract, I want to see it. Is it up to date? Make sure it's there. It's in the data room. So that's the reason I mention it, because it was small, but it did have a major impact on everybody because the cost of the deal went up a little bit because everybody was scrambling around and lawyers were talking to lawyers and where is this contract? And it was just a lot of heat that we didn't need right at the 11th hour.
Nowadays, most contracts are being signed electronically. Are there any issues with that?
No, that's a much more efficient way to do it. I'm talking quite a while ago, and these were paper contracts.
Yeah.
But being even electronically, I mean, if you're using a system, that there's hosting of those contracts once they're signed, that's a much more efficient process. That's going to be automatically almost put into a data room. But if you're having them signed electronically and you have custody over those, just making sure that they're stored, they're backed up, and that you've got them at the ready when the time comes. Because a lot of people now are using virtual data rooms. They're using electronic data rooms. Nobody's going through a paper data room. Not very often anymore. I mean, this does happen in some cases with more mature businesses, but a lot of people now are using virtual electronic data rooms.
Mm-hmm.
Hey, Jeff,
Jennifer has. I was just going to add one comment to the contract issue. The bigger issue is change of control provisions. Sometimes suppliers, like big suppliers, will have that as part of their boilerplate terminology, but try and resist that as best you can because, as Jeff mentioned, near close, you got to get these consents from these suppliers to a change of control, and that can be problematic. So certainly with very small suppliers, I would resist it heavily, but bigger suppliers, you may not have a choice.
Yeah, good point. I agree.
Jennifer, you had your hand up. Do you still have a question?
Yeah, a couple actually, so I'll make it really quick. First off, Terry, just to interject, you mentioned suppliers. That I can suspect that may be true if I look through some of our contracts with customers too, and large customers having change of control. Mm-hmm. And some of them who are not flexible, I wouldn't have the power to really say a lot. I wanted to ask Jeff, you talked about history of actuals to budgets. When you talk about history, how far back are you talking? Is it just the current year or the previous year, or is it further back than that?
Well, when you're going through your history to actuals against your budget, it'll be the current year, but that's a management process that you should be going through because that kind of rigor is really helpful and be able to demonstrate that rigor. I've had cases where people have asked for, okay, can you give me your quarterly management reviews for the last 12 quarters? I kind of want to just see what dialogue have you been having as a management team, what actions have you been taking, how have you been dealing with variances? And typically buyers will want to look at, my experience, Terry, chime in here, but 3 years of financials at least.
3 years is about the norm, I think.
Yeah, I can appreciate the 3-year thing. I guess my question was the actual sort of actuals to budgets. I guess the actuals sort of matching it up against what the budget was, I guess in my head was sort of thinking.
Yeah. And I think
how good is the forecasting, I suppose.
Yeah, that's a good point because a buyer will want to know how well does management budget? How well does the management team forecast the business? How close have actuals been to budgets, or budget's been, just very rosy and the actuals have come in at much less than budgeted? They'll come to the conclusion that, okay, the management doesn't have a good fix on what its opportunities are for the business. Budgets have been too rosy and there's always been big variances. So having that be able to demonstrate that rigor, that when you're doing a budget, you're taking a very good, hard, realistic look at the business and basing it as much on fact as you can,
Yep.
as opposed to assumptions. So actually, it's a really good point.
Yeah, although when you're a startup, you don't always have
Exactly.
that. But the other question I just had is I know the sort of M&A market and investment markets really changed a lot over the last sort of, I would say 9 months, even less than a year. What kind of, do you have a handle on what kind of multiples you're seeing for different kinds of companies, or how that might have changed?
I can talk to that. So again, the multiples really depend on the industry and the vertical, and to some extent the size of the business and the nature of the revenue. So it's pretty multifaceted. But in general, I think since about February, valuations have come down probably 15-20% maybe. So for example, in the IT services space, we were looking at, MSPs or other IT service providers. Typical multiples were in the sort of before the correction was around 7-8 times EBITDA. That number's come down to about 6 to 7 times, something like that. So again, it's very industry dependent and very dependent on the company. So again, more bricks and mortar traditional industry businesses are more in that 4-5 times EBITDA multiple. Tech companies are in, anywhere from 7-8 to 15-20 times EBITDA. And then SaaS companies are often valued on as a multiple of revenue. It's not really a function of EBITDA. But actually, I was going to say that Jeff and I we're going to do a part 2 session to this webinar, which we're going to drill down a little more deeply in all the different valuation methodologies for companies. So we will cover that in more depth on a follow-up event.
Good, that would be helpful. Yeah, thank you.
Okay, do you want me to dive in?
Yeah, sure.
Can you go to the next slide? Okay, so as I mentioned, what we talked about here is there was so much to talk about on the topic. We thought we'd split it up into 2 parts. So today is more about positioning and getting the company ready for an exit. And then the next session will actually talk about valuations. So Jeff touched on some of these things, but just things to consider as a founder. What are your financial objectives in a transaction? And it might sound like a dumb question because most people are going to say, well, I want the most money for my business, but it's not that linear. Sometimes you may want more cash up front, but a lesser value. So for example, when we structure deals, there's often earnouts or vendor take back notes. So it really depends on your objectives. So if you want the highest valuation, you may not get all of that cash up front. You may end up having to earn it out over 2 or 3 years, or you may have to take back a note for 2, 3, 4, sometimes 5 years to maximize the valuation. So just start thinking about, what are your personal objectives in doing a transaction? Also, a big problem is founders don't always have reasonable valuation expectations. They heard that, company X got sold for Y dollars and they want the same kind of valuation, but they may not be apples to apples. So it is often useful to sort of do some market research to see what comparable companies are selling for. So there's tons of different valuation methodologies, but at the end of the day, a company is worth what someone is willing to pay, and the best barometer of what someone is willing to pay is market comps. So if we can go out and find, and this is what we often do even on a buy side mandate, is we'll go out and do a market analysis and say, what have other similar companies like this one been sold for recently? And that's really the best tool you have to validate a valuation. Other things to think about is, in many cases, the founders have spent 20, 25 years building the business. Are you really ready to part with your baby? Sometimes founders say, I think I am, but when push comes to shove, they're not. So you need to make sure that you can get over that emotional hurdle of parting with your company. And some of the copy is cut off there, but I think what that says is do you care about what the buyer does with the company? In other words, do you want to protect certain employees? Do you care if they, completely change the business after you're done? Those are things that are sometimes more emotional issues than financial issues, but you have to sort of wrap your mind around those things. It's not always just a pure black and white financial issue when you're selling your company. Okay, next slide. There we go. Okay. The other key thing you have to think about is what role do you want to play in the new entity? Generally, buyers, want the founder to stick around for a little while at a minimum for a transition, or in other cases, the founder becomes a key part of their larger organization and they want to retain them for a long-term role. So it depends. So you need to think about, what are you prepared to do? If a founder wants to check out immediately after closing, that may have an impact on the valuation. And another thing you need to think about is, again, what do you want to protect employees? If you've got, say, 2 or 3 key employees that you're really loyal to, and you want to ensure that they're protected, that may become an issue in negotiating the deal, and it may even have a small indirect impact on the valuation. So again, you have to think about some of those things post sale. And another thing that often happens is companies say they're ready to be sold or want to get sold, but they're not quite ready. So that's why we decided to talk about these foundational issues of getting your company ready to sell. We often talk to founders, and sometimes it's a 2-year process to get them ready for an exit, to really optimize the value of the business. A lot of the building blocks that Jeff talked about. So, but sometimes it's just a minor pivot or repositioning or repackaging of the business. For example, we're selling a company right now that was historically a hardware and services business, but they've pivoted towards a recurring revenue model and a SaaS model. And as soon as they made that pivot and started driving some of that sort of recurring revenue, their valuation opportunity went up considerably. So sometimes it's just a minor tweak to the business that can help you package it better. So we're positioning that company as a growing SaaS revenue company, not a traditional hardware and engineering services company, as an example. Okay. And as Jeff, just go back one slide, Jeff. One last point. As Jeff mentioned earlier, you really have to start planning ahead. And again, it's at least a 1 to 2 year process to get your act together and get a company ready for a transaction. Okay, next slide. I'm not going to touch too much on this, but there are obviously legal considerations. You need good legal counsel. And I always tell people, you want someone that does M&A work, not just a generalist corporate lawyer, because they may not be familiar with a lot of the nuances of doing merger and acquisition work. But in general, you just want to make sure your house is clean, right? Settle any outstanding lawsuits, even if there's a potential lawsuit, because you're going to be giving reps and warranties that there's no pending or potential lawsuits. You want to nip those in the bud way ahead of time. I think Jeff talked a little bit about corporate structure with your tax advisors and complex structures. And I've seen small companies have, 3-4 companies and layers of holding companies and things like that. It's nonsense, right? Like, so the simpler your corporate structure can be, the easier the transaction is going to be. Sometimes you need a holding company or you have family trust, and that's all fine. But again, simpler is better, and eliminating unnecessary subsidiaries and things like that will streamline the process. Okay, next slide. It kind of sounds obvious, but improve your bottom line. If you think you want to sell your company, say a year from now, then you need to make some mercenary decisions on, are you going to optimize the bottom line, right? So maybe look at cutting unnecessary staff to improve your margins. Maybe don't invest in new marketing or other product initiatives that won't bear fruit for 2 or 3 years. So think about just optimizing the bottom line, because ultimately, 80% of businesses are sold as a multiple of EBITDA, and the bigger your bottom line is, the more money you're going to get. So now you can't do things that are artificial or unnatural for the company. So slashing, a third of your staff to improve your bottom line when you can't deliver on your revenues later is not a good strategy, and buyers will see through that. But really looking at cutting any fat that you can. And then obviously increasing sales, and that again also sounds obvious, but if you can possibly pivot a little bit and open up new revenue streams, or build new distribution channels, those are going to be valuable. Sometimes acquirers will buy a company purely for its distribution channels as a key thing, or sometimes for their technology. So just think about creative ways of driving sales growth. At the end of the day, valuations are based on two things: revenue growth and EBITDA. Those are the two primary factors. Okay, next slide. We're running tight on time. Jeff touched on this, but I think you need a team of advisors, and doesn't mean they have to be working, full time on an exit strategy for a year, but you need people sort of in your pocket and that you can lean on. So that includes you're going to need a good M&A lawyer. You're going to need accountants and or a CFO. You're going to need a tax advisor, which may or may not be your accounting firm. You probably want to talk to your wealth management advisor for planning for what you're going to do with some of the cash. And don't forget, you cannot, for example, set up a trust 6 months before you want to sell your company. It doesn't work that way. You have to hold the shares for a minimum of 2 years. So again, build up a good suite of advisors. Okay, next slide. Okay, and this is the number one thing I tell founders to do when they're even thinking about an exit, is start thinking about who the ideal buyer is. And sometimes those are financial buyers, private equity groups, family offices, but often strategic buyers will pay the most money for a business. And sometimes aligning your distribution channels or your technology or your product suite to better fit with one of these strategic buyers can really yield huge results. So just start thinking about who the optimum buyer would be and who would pay the most money for your business down the road, and that may impact some of your strategic decisions in where you direct the business. Okay, next slide. Yeah, we'll go to this one. The last slide is create a management succession plan. So often companies are, founded by one or two people, and they run the business and everything flows through them. That's not a scalable model for a private equity firm, right? So you need to build in a succession plan and have a layer of management beneath you so that you become dispensable. Okay, if the founder is indispensable to the business, they're either going to lock you up for a long time, or they're going to apply a discount to the value of the business. Okay, so you need to and the other thing you need to do is put processes in place where the business can virtually run itself. The biggest failing with many founders is they're too busy working in the business instead of on the business, and don't leave time for strategic thought, and they get into that death spiral of just kind of not growing the business and it's essentially a lifestyle business or a job. So think about building a management team beneath you that can make you dispensable. And we're right at 9:30, and I think that's it for our time.
Anybody have questions for Terry, or even back to Jeff? No, there we go. You've answered a lot. The next one, I was just looking back through my notes there for both Jeff and Terry, is that the next session is actually going to be on January 26th. And then you had talked about, you said one of the future sessions will be a little bit more on valuation. And I know some of the other ones that we had were alternative lending and accessing grants. So those are some that are upcoming. I'll reach out to you, Jeff, as well, and just kind of see what order we'll put things in. Thank you very much for joining us today. We have a lot of other things. Prasad, you got your hand up.
Sorry, guys. This was a phenomenal session. I loved listening to it all. I think, Terry, you and I had a conversation similar to this probably about a year ago, or even longer than that. And unfortunately, I have to say that I haven't gotten any further than when the advice you've given me from a year ago. The question I have is, like the amount of effort and work and content that you've provided, it's like running, a separate company while the company is running. And just because, you're pulling all the data from one side and, feeding it into this, what is it called? Data repository,
Data room, yeah.
data room, and so on. And what do you think the timeline is? Let's say I start today and I start building all this information. How, let's say I won't get 100% of everything that you've outlined. I'll get maybe, of the key things that you're talking about, maybe I'll get about 50-60% of that, the key things that are necessary. Let's say that takes me 3 months, and I'm just guessing at this point. What do you think the next step is after that? Is, engage an organization like yours, go after strategic suppliers who may be interested in our solution? Like, how do I present that, the content and the solution, and what's that next timeline? Is it another 6 months? Is it another year? Like, what should I be thinking about?
So that's a hard question to answer. So I think you need to separate into two sections, right? One is the transactional related issues, and the other one is a lot of the content we talked about, which is sort of building the foundation for the business and positioning it to get ready for an exit. So I don't think you need to go start building a data room today. Normally that gets triggered when you've got a suitor that's knocking on your door, right? Or you've engaged someone like us or any M&A advisor to start the process, right? So I would say the getting ready for an exit can take as long as you need to get you ready, right? And but then if you decide you want to sell the business, then I tell people you need to bank on 9 to 12 months. It's a 9 to 12 month process. I've seen companies get sold in 6 months, but that's an aberration, I would say. And so if you said, I want to sell the company starting today and engaged us, for example, we're probably, generally an advisor would need about 3 months to build the entire package. Okay, 2 to 3 months to build a whole selling document, financial model, and package. And then it's really only once you're at an LOI stage with a buyer that you need to go build the data room and things like that. So I wouldn't spend a whole lot of time on building a formal data room. I would, do all the things we talked about, getting your financial house in order and all the other things way ahead of time, but you don't really need to deal with that. So generally a transaction takes, 6 to 12 months, but I'd say 9 is probably a good median number from once you engage someone.
Perfect. Okay, that's good.
Okay, any other questions?
I was just gonna say it's make sure you're doing your budget, make sure you're doing your quarterly reviews of forecast to actuals, and that you know where to find those documents. Like they're not just randomly on some hard drive somewhere, but start to make sure that you're putting some rigor in all of those things.
Yeah.
Mm-hmm.
So that when the time comes, it's then easy to, okay, oh yeah, I know where all this is. I've done the work already. Yeah.
Yeah. And the other thing I would say is having a good CFO working with you is really important. Doesn't have to be full-time. It could be a fractional CFO, but having just the founder and a bookkeeper is not a good recipe. You really need some financial rigor and expertise at the table, because a lot of this is financial, right?
Right.
The contracts and other things you have to have processes in place and document things, but a lot of the rigor comes from a CFO type person.
Perfect.